In life, a lot of patterns tend to repeat themselves, and it's very hard to get outside of that pattern and truly overcome it. And that is exactly the case with businesses in certain industries. There's a lot of businesses that try to step out from what the industry averages and their industry economics are, except it's very hard to do and very rare that it ever actually happens. And so most businesses are kind of destined to have the same sort of economics of the industry they operate in. And for those reasons, there's certain industries you want to potentially avoid or at least scrutinize these businesses in these industries even more than you would otherwise, because the base rate of businesses in these industries that we're going to talk about is that they're going to be pretty mediocre. And so one of the kind of pinnacle examples of a bad industry is airlines. Maybe you heard Warren Buffett talk about how he has a 1-800 number that he calls every time he even thinks about investing in an airline to talk him out of it. Except, then it turned out he also did invest in airlines kind of recently and then said it was a mistake. And so the reason why airlines tend to be poor businesses is for several reasons, actually. One of them is that customers tend to have pretty low loyalty. The reason why they have loyalty programs in the first case is because of the low loyalty to a flight. A lot of times when you're looking for a flight, you're more sensitive to the time of the flight and the price of the flight than who is the actual airline running it. And so you kind of want to look at all your options to see the best time and price first, and then the actual airline it is a secondary consideration. That just means it's going to be very competitive, especially on the price aspect. Another aspect of this is the fact that it is a high ticket, infrequently purchased item. What that means is that every time you go on a trip, you're kind of going to start your process again. You never really build that much of a habit of going to an individual airline site and then always just booking on them. Now, the exception, of course, is if you do build loyalty with an airline and maybe you are a business traveler who does frequently travel, and that is why they fight so hard for those customers, because they are a little bit better quality customers. But for the vast majority of people who book flights, every time they book a flight, they'll start over on Google, they'll compare different options, and they're open to taking multiple different airlines. And so since it is so infrequent, you don't build a habit. And since it is a high ticket purchase item, you're willing to put that time into it to kind of research it every time. Whereas in contrast, laundry detergent that you're buying all the time, you probably pay zero attention to even the fact that you're grabbing the same bottle. You just made that decision a couple times in the past and you just keep repeating it. That is another reason why airlines tend to not be great businesses. On top of that, there's the fact that they have very high fixed cost. And the byproduct of the very high fixed cost means that if a plane is, let's say, 80% full, they're probably not even breaking even, and they're certainly not making any money. And so filling up those last seats on every plane has a very low marginal cost because all of the cost is embedded in the actual flight itself, not in, serving a couple more peanuts to an individual passenger or, the little bit of extra gas it'll take to carry their weight on the plane. It is in the actual plane itself. And so because of the very high fixed cost, there's another way of saying there's a very low marginal cost on an individual plane to servicing, the last few seats. It means that they want to fill those up. And there will be price competition in order to do that if necessary. And so if a plane is 80% full and they're flying pretty soon and they don't think they're going to be able to fill those seats otherwise, they'll just lower the prices. And that's where a lot of price competition comes from because they do need to fully fill up every individual plane. Whereas, a company like Hermes who will make leather bags, if the demand isn't there for one of their collections, they don't need to sell it. They can hold it for a longer period of time until someone buys it, or they could destroy it. And in fact, that's actually what they do. They do destroy items they can't sell because it'll hurt their brand image. And if you're thinking about an airline, they can't do that if they're an airline that has 4 seats left on the plane, because once the plane leaves, they can never sell those seats again. And so they actually do have a lot of pressure to sell those seats. And that is not just because once the seats go, you'll never be able to sell that product again, right? You can't sell the seats on a flight that already took off. And so you need to get that sale to happen. But also, again, because of these very low marginal costs, you're kind of okay accepting a lower price for that. And so that is another kind of factor going on there. And then there's also the fact that there's just a lot of different airlines to choose from. And people can also substitute. If a price gets too high, maybe you say, I'm not going to take that trip to that destination. Maybe I'll go somewhere else. Or maybe I'll decide to drive it instead. Or maybe we just won't go this year. Or instead of this expensive airfare that kind of seems like a ripoff, we'll buy TV. And so for all those reasons, airlines are not a good business. They're characterized by very low profit margins. We're calling it like 0 to 5%. If they do make money, a lot of the times it is because of that loyalty program. That's kind of another factor we could talk about later. But it is an industry, if you want to research a business in it, you want to be very careful of that fact that most of them are going to be super mediocre businesses. And there's also, since it is such a mediocre business, if anything happens in the macro economy, by the way, travel tends to be very sensitive to how well the economy is doing or poorly. And so if the economy turns, you're going to get a period of losses again, because if you're not filling up those last seats, you're not making money, because most of the profits of a flight come from filling up those last seats. However, there are exceptions even to this rule, which is if you think of Southwest, which when it was run by Herb Keller, who was the founder of it, there was some 3-decade plus period where they never didn't make a profit. And that is incredible statistic by airline stats. And, comparing Southwest at that time to all their peers, there was many, many, many years where they lost money. And so what did Southwest do that allowed it to make a profit where others failed? Well, that's actually a very interesting story. I think we'll save it for another video. But the point I want to hit on here is that the expectation would be that they would not be a good business. And so if there does happen to be one airline out of all of them that tends to be a good business, it is going to be an exception. And even though Southwest was an exception, it was only an exception when it was run by Herb Keller, and it is no longer really the case today. They have had losses since he left. And so that also could kind of allude to another question we've asked in the past, is it a great business or is there a great manager? And that's just something to think about there. But let's move on to another industry, and that is financials. Financials is another industry that tends to be pretty low quality. Now, it's a little bit of a paradox because a lot of these financial institutions actually have pretty high returns on equity, but they have very low returns on assets. And that is because of a lot of leverage that is employed in them. And so when thinking of a bank, though, leverage is a little different than thinking of other businesses. And that is because they're in the business of leverage. It is their actual business to take in money and then to loan out other money. But as many people maybe forget, every time someone puts money in the bank, their ability to lend money is actually going up. And so they could have kind of more debt outstanding, and how much they're able to lend for every, dollar they're taking in of their assets. This is going to be dictated by a bunch of complicated banking formulas. They have different leverage ratios they need to abide by, different capital requirements. But, by and large, rule of thumb, if you're taking in $1 of deposits, maybe it's something like $10 of loans you're able to go ahead and give out on that. And so that is, though, a lot of leverage that's kind of inherent in the business model. A little different kind of leverage than we typically think of with other businesses, but it's still the case that it needs that in order to succeed. And it's still the case that because of that, if you do have loan losses that are, loans that do not get paid back, even a small amount on a percentage basis could wipe out the capital base. And that has happened before. With Silicon Valley Bank, they didn't necessarily have loan losses, but they did have a deposit run. And when that happened, because the nature of the bank not holding actually enough money to feed all the deposits, because again, there's leverage inherent in the banking business model, they collapsed and had to be acquired. And so that does happen. That is not really the reason, though, why banks are not a good business model. It has more to do with the competition. Most people don't actually care where they bank. There's a little bit of a difference between consumer and commercial. Consumers probably don't have the greatest feeling for banks, probably find that a lot of times they have a lot of hidden fees. They're kind of annoying to deal with, at least for a long period of time. Even now, really, they don't give you any interest unless you go to, a special high yield saving account. And so because of all that, people tend to not really have high loyalty to a bank. It is really annoying switching your bank account, though. And so because of that, it does tend to be pretty sticky. But it's not because you actually like the product. It's just because you don't want to leave because it's a headache. And there is a difference there, because that does mean that the bank, if they do certain things, they can push you to leave pretty easily. And so it's a different scenario than someone loving the product, and that's not why they leave. It's really just because it's a total headache. And it kind of seems like all of these different banks provide different headaches that are unique. And so that is one of the reasons why a lot of competition that just basically offers a similar product. On the commercial side, there's, people within a lot of big businesses whose job it is to manage different banking relationships. And yes, it's true, kind of there could be a one-on-one relationship. You really like a certain commercial loan officer, and so you want to continue to work with him. That is kind of a real advantage they have. Even there, though, it's kind of that individual that's building their personal brand. And it's not really the bank themselves you're loyal to, it's that person. And so could the bank do things that got that person to leave? Yeah, absolutely. And so that's another factor there. If you're zooming out big picture, a bank might have a return on assets of like 1 to 1.25%, and then they're leveraging that up to 8 to 10 times, and that's going to get them a higher mid-teens return on equity, which can be decent as an investor. But if you were going to employ even moderate amounts of leverage to other businesses, it would have a much higher return on equity than that. And the other thing that's really important to note is that when a bank grows, it actually requires a lot of capital because it is literally statutorily mandated that they retain capital in order to grow. And of course, a good business doesn't need capital in order to grow. It can grow without that capital. And so maybe you can make an argument, well, it's not that much capital, sure, but it still does need more capital requirements in order to continue to grow. And then there's always the risk that if there is an exogenous financial shock, that something could happen to the bank that takes it out of business, which is what happened with First Republic, Silicon Valley Bank. These things are rare, but not that rare. And when you are an investor, you don't want to take any sort of terminal value risk. Maybe if you're a VC investor, you're okay with some of your bets going to zero. But if you're like most investors, and at least on a bank investment, because it's not like the upside is going to be that much if everything works out. And so that's different than VC investing, where if it does work out, you get your 100x, 1000x. This is going to be, kind of an average to maybe, if you're lucky, above average return. But if the downside is that you lose everything, that's probably not going to be asymmetry that you want in your portfolio. Of course, everyone gets to have their own opinion on this and what they choose to include or not. But that's just a few reasons though why, if you are looking at financial institutions like a bank, you want to be a little bit more careful. And I personally, at least, usually don't want to look at a company of any sort unless they're providing value to customers that no one else can easily provide. And that is just not the case as far as I could tell with most banks. Maybe there's exceptions with some new fintech firms and they're doing something unique. There's always exceptions to the rule. But this is just generally about where you want to increase your caution and also about where you maybe want to spend more time looking versus not looking. And so that is another industry. I'm going to hit two more really quick. The first one is going to be fashion and apparel. You've probably heard this before. The real reason there is just that consumer preferences, the things people want, can change very quickly. And in a clothing company tends to only be good at a few things. There are some that buck that trend, absolutely. But if you're thinking about someone like Crocs, well, they were good at making Crocs and then they went out of style and then they almost went bankrupt, and now good for them, they're back in style, so they're doing really well. But if they go out of style, it's not like they really have other things to fall back on. And so the success of that business is very much predicated on people buying Crocs and not finding some other, sort of rubber sandal that they prefer more. And so that is your judgment as an investor when you are investing in a company like that, is whether or not you think people will continue to preference that sort of style. And the reason why fashion and apparel companies are hard is just because it's hard to know what preferences people will have with style out into the future, but also just even next season. And even clothing companies themselves have a lot of issues with that. A lot of times clothing companies will design clothes on, about a 9-month lead time, something like that. And there's a lot of misses in their collections that they have to end up discounting. And then when they're discounting in the store, that hurts their brand. It also means that some customers are going to be hesitant to actually buy the items because they expect some to go on sale. Also, the fact that you do need to hold inventory so early in the season so you don't run out during it, because you can't make clothing that quickly. And if you miss the season like summer, then you can't sell, the shorts in winter. It means that they have pretty high working capital, a lot of inventory holding cost. And then again, same thing, you can have inventory obsolescence as a risk of that. And so that's a few reasons why they tend to not be great business models. And the best kind of fashion apparel models, you could think about Zara, which is owned by Inditex. That is going to be a company that has very quick cycles and doesn't actually focus on any one specific trend, but rather just jumping on trends as quick as possible. And Shein actually went even farther than that because they just throw everything out there in kind of micro batches, and whatever works, they're able to scale up very quickly. And I actually wrote a memo on different retailers and the business quality, comparing Shein, Zara, and some more traditional retailers. And in the show notes, I'll put a link to that memo. It's free to read, but if you want to learn more about that subject, I think you'll enjoy reading that. And so moving on to the last subject, that's going to be oil and gas companies, specifically those in exploration and production. This also tends to be an industry that you want to have more caution in, because while you could have an oil company that is making a lot of money, has really high returns on invested capital, it's not really the business itself that is doing that. It's really more the asset. They have a good asset, but not necessarily a good business. And that distinction is really important, because if you're thinking of what their asset is, it's oil. It is going to be depletable, and you can't replenish it unless you go out and search for new oil. And everyone knows, of course, it is not that reliable whether or not you're going to find that new oil field. The other really big thing with oil is that it only makes sense to extract it from the ground at a certain oil price. And of course, it is very hard to know whatever oil prices are going to be. There are certain fields like the Guara field in Saudi Arabia, if I'm pronouncing that right, that is able to produce oil for, under $10 a barrel. And so almost no matter what the price of oil is going to be, they're going to be able to make some money off of it. Of course, if it's a higher oil price, they have much more operating leverage on that. They're much more profitable. But if you are invested in a company that maybe is in the US and it's shale oil and the break-even oil price is $40 and, oil drops back down, then you could be in trouble, and you could be looking at a company that is, barely making money or losing money, especially after you layer in all the other fixed overhead costs and all that. And then especially if they have leverage, they could go bankrupt. And that does happen to oil companies very often, because they do commonly borrow money, go out and try to find oil fields. If they don't find them, that's not great. If they do find them and then the oil price plummets, that's also not great. You also have the fact that it's very expensive to set up oil wells. And once it's set up, you have that big capital outlay already. And so if oil prices fall, you can't undo that investment. It's already done. And so then you're kind of stuck either leaving it, kind of not pumping any oil and waiting. And again, if you have debt, that's going to cost you money, but it also means you're just not generating anything from that, which is not a good ROI on the investment if you have to wait longer. And so those are a couple reasons why oil and gas tends to be an industry you want to be a little more suspicious of. On the other hand, you could have an opinion on where oil prices are going. You could have the opinion that energy is still an essential input into basically the entire economy. And we're going to, at least for some period of time, need some hydrocarbon-based energy. And so I know it's something that's essential to us. Maybe I don't know what prices are going to be in a given year, but the way this business is set up with very little debt and it's run, I think over, the fullness of several decades, it's going to be profitable. And, you could take that opinion. You could also say maybe it's a hedge to my portfolio, because if energy prices are going up, or maybe if there's stagflation, that could do well, when other businesses in my portfolio tend to do poorer, because, the input cost of energy means their expenses are increasing on those other businesses you own. And so that could be a reason why. And I have some suspicion, he'll never say this, that's one of the reasons why Warren Buffett actually owns Occidental Petroleum, is a little bit of a fear of stagflation, because he has in the past kind of talked about some of the issues with oil companies. But if you do own one, but on the other hand, and Charlie Munger talked about this too, it's a precious resource that we're not clear exactly how limited it is, but it is certainly limited. And if you own an asset of limited scarcity, some people also kind of just like that. And so it depends, is what I would say there. But it's something you want to be careful of, especially if there's a lot of debt, or you need to assume a pretty high oil price in order to actually be profitable. And so those are some different factors to think about for a few different industries. Again, this doesn't mean you don't ever invest in businesses in these industries. It just means that you need to have higher caution. Or if you are thinking, where should I start to find a business I want to invest in, maybe don't start there. But that is entirely your decision, because on the same token, sometimes looking where other people are not willing to look could provide good opportunity. And so that is just another way of saying that nobody knows for sure, but hopefully that helps give you a little bit of context. And if you do want to learn more about business and investing, make sure you subscribe and hit like. And we have much more coming in the future. And if you have any questions though about anything in finance, investing, running or analyzing a business, go ahead and drop the questions below and I'll get to them as soon as possible.